Hello, I'm Matt Klukas, President and CEO of Criterium Energy, and today I will highlight some important figures and updates from our 2024 year-end results and Q1 2025 operational update as presented in our press release and presentation dated May 12, 2025, both of which can be found on our website. 2024 was an important and transformational year for Criterium Energy as we announced the acquisition of Mount Dore Petroleum in January of 2024 and assumed operations of the Tunkal and West Salawati PSCs. Now, the production and resources within the Tunkal PSC are really our foundation for operations in Indonesia. This is complemented by the significant upside and optionality held within the West Salawati and Bulu PSCs. Today, I will be making forward-looking statements, and I just ask that you refer to this disclaimer, which can also be found on the presentations on our website. Our results last year demonstrated a company moving in the right direction, focused on cash flow growth, reserve and resource growth, a strengthening balance sheet, and an exciting emerging gas play. We increased cash flow from operations quarter over quarter, exiting the year with US $1.7 million in Q4 alone. This is an adjusted number as it also includes a lifting that occurred in early January for our December production. The increase in cash flow is largely due to our production increases through a successful workover program and cost reductions realized throughout the year. This also occurred in the face of decreasing oil price. We reduced total debts and gross debt by 2.5 million over the course of the year, and we exited with total gross debt of 23 million with a weighted average cost of 8%. A significant overhang exists due to this debt, but with its favorable terms and the flexibility offered by the lenders to execute our capital program, we encourage that this can be managed and reduced. A key highlight of the year was the release of our updated reserve and resource report, the first for these assets under Criterium management. Demonstrates robust reserve valuation, 160% reserve replacement ratio, and also highlights the emergence of this gas resource play that our team has worked diligently to define and characterize. And further delineation of this will really define 2025, in which Southeast Mangope development remains on track. We are very encouraged by the evolution and pace of this gas development, and given the robust market in Indonesia and our proximity to infrastructure, we see material production gains with modest capital and low risk. Southeast Mangope is set to be the first of many developments of the Tunkal PSC and will sell into a fixed take-or-pay contract, generating stable and predictable cash flow for our company. The year of transformation as an operator was also the year of transformation from a cash flow perspective. As I alluded to before, our cash flow growth was really on the back of a production increase of 30% since acquiring the asset and a sharp decrease in operating costs. This could also have been much more should the results from MGH-43 been as expected. We continue to evaluate the results of that well, but nevertheless, we have built a foundation from which we can now grow. I would also like to use and highlight the favorable pricing environment we operate within. On the oil side, we averaged Brent pricing throughout 2024, and in Q1 of this year, that we've actually seen an increase in a premium to Brent of approximately $3.5 per barrel. Now, this is the options we have of being able to sell both domestically and we can export it. This allows us to garner a favorable price for our oil. This story remains the same with gas. And while it's likely that we sell our gas domestically, we can reiterate the guidance of $5 to $7 per MMBTU for production from the Tunkal PSC, which we see as very favorable pricing and able us to generate cash flow from very high margin production. We will remain active across our diverse portfolio in 2025 with a focus on maintaining oil production and diversification and growth in gas. Our oil production comes from 2 oil fields within the Tunkal PSC, the Mangope and PLT fields, which currently produce approximately 1,000 barrels a day. Our activity in 2025 will be 8 to 12 workovers, which are planned. We've completed 3 as of Q1 2025. Our onshore gas is also within the Tonkal PSC. There's a total of 5 gas discoveries, which I'll provide a bit more detail on earlier, and each one can be brought online with 2 to 5 million capex to bring to first gas. The 2025 activity is focused primarily on the Southeast Mangope development. Once online, bringing 5 to 7 million cubic feet a day and targeting Q1 2026 for first production from that field. Our offshore gas is within the Bulu PSC in the Lango gas field. It is also proximal to underutilized infrastructure, and in 2025, we will continue to progress the sale in parallel with playing a more active role in the Lango development. As you recall, this is a sale process that has been going on for some time. We continue to work with the existing buyer, but in parallel, we will take a more active role in the development of this project to maintain value for our company and shareholders. And finally, we do hold a very robust exploration portfolio. This is in both the Tonkal and the West Salawati PSCs. Specific to West Salawati, we have a material onshore and offshore prospect inventory, a very favorable cost recovery pool, and we'll mature these prospects with the intent to bring in a partner to assist in the drilling of any prospects likely in 2026. As mentioned, this reserve report, which we released in March, is the first under Criterium management. And breaking down our 2P and 2C outlines 100% production and reserves from the Mangope and PLT oil fields. So all our reserves right now are currently oil. And we have a large majority of our contingent resources held within our discovered gas fields. What's unique about these gas fields, as we alluded to, they are all very close to infrastructure and can be brought online very cost effectively. As our 2025 capital program is executed, specifically around Southeast Mangope, we will start to see the transition of some of these gas resources into the reserve category, even before production has commenced. For many of these, an upgrade to the reserve status will come with the gas sales agreement, which we are actively progressing. Now, regarding Bulu, it is clear that this remains an important part of our portfolio and underlines our plan to take an active role in the development to maximize value through the project or through a divestment. As gas becomes more and more of a focal point for our company this year and in the future, we want to walk through the guide or converting discovered gas to reserves and into production, and we'll focus on the Tonkal PSC and the 5 gas discoveries held within it. With each of these discoveries, for them to be classified as reserves, we of course need a discovery well with a production test, but we also need an approved plan of development as well as an approved gas sales agreement. And as you can see, of these 5 discoveries, we have progressed each sequentially. So starting with Southeast Mangope, which is our 2025 focus, we will be confirming the plan of development, either the pipeline option or the modular LNG option in Q3 of this year. And shortly after that, we anticipate signing a gas sales agreement, which will then transfer this into the reserve category. With Machan Gadang, it is really about confirming this development plan and progressing towards the gas sales agreement for that project as well. In North Mangope, where we have 4 wells which were suspended in 2014 due to high gas rates, we will re-enter and conduct production testing on each well, the results of which will help drive the appropriate development plan and ultimately lead to another gas sales agreement. With Chera, this is a well that was drilled in 2008 and encountered gas in the shallower Gumai zone. This gas was never tested, so our intent will be to test these volumes, which will require re-entering or twinning the Chera 1 wells. But the volumes have the potential to be quite material, with 26 BCF, and the development plan would be relatively simple, as it's located only 2 kilometers from the main gas transmission line. We anticipate any activities in Chera will be conducted in 2026. And finally, Mangope 43. While this well targeted the TAF zone for oil production, we encountered a significant 13 meters of net gas pay within the Gumai formation, which sits above our oil reservoir in the Mangope field. We're currently evaluating the potential volumes and will bring forward a plan to test this discovery and understand the true production potential of it and a subsequent development plan to follow. We anticipate this activity will also occur in 2026. In summary, 2024 has set us up for a successful year ahead, and even in the face of volatile oil prices. Our focus remains on maintaining oil production, developing Southeast Mangope, and progressing our gas developments. As we manage our balance sheet, we are well positioned in a shifting market and believe recent events have validated our company's strategy of acquiring undercapitalized assets and developing a diversified oil and gas portfolio in Southeast Asia. For more information, please review our website and the documents available on it, and I look forward to sharing more updates with you soon. Thank you.